The story broke on Friday, at least out of the British press, that Russia was closer to invading Ukraine than anyone had expected, and therefore the market reacted violently. And that, of course, came on the day before when the St. Louis Fed president, James Bullard, said that he would not be opposed to a 1% increase by the Federal Reserve. So a combination of those 1-2 punches certainly unroiled the markets.
Well, he actually said a 1% increase in the Fed funds rate by July, which basically means a 50 basis point hike in March and two subsequent 25 basis point increases. But on Friday, the bond market was all over the place, got as high as a 2.05 yield, but settled at about 193 as a flight to safety ensued on the Ukraine rumors.
Right. So the 10-year, it's interesting what happened is the 10-year Treasury yield went down. And why that happens, folks, is because people run to safety. And one of the things that they buy are bonds, 10-year bonds. And of course, the U.S. bond is the safety trade around the world. And so all of that buying pressure presses down yields. And so you look at the 10-year Treasury and say, boy, oh boy, it just doesn't connect with the biggest news of the week, and that is a 40-year high on inflation. I know if you've been listening to the show, this is not a surprise. We've been talking about this for nearly 6 months, that we didn't think it was transitory, that it was more permanent, and that it was going to spike, and here it is.
Right, and a lot of the green energy thing is contributing to that because oil prices were a big reason the CPI surprised on the upside. In addition to that, when you think about where interest rates are in real terms, and with an inflation rate of 7 and a 10-year of 1.95, that's a 5% negative real yield, which really does behoove you to buy things, at-risk assets and whatnot. But, we're flushing it out because really we've seen a regime change. There used to be the high-growth names have been under pressure, but more value-oriented companies that have earnings and have attractive cash flows are trading reasonably well.
And so that, what you just talked about, is really an outlier. When you have inflation at such a high rate, and the fact that the Federal Reserve is so behind the curve on controlling interest rates, something is going to break. In other words, one of two things is likely going to happen. Number one, inflation is going to retreat and come back down, or bond rates are going to come back up and close that gap. It's likely that both of those things happen.
Right, and we've seen also the flattening of the yield curve, and that's something you want to be watching too, because if the yield curve inverts, that tends to suggest recessionary risks are rising, and that would require a real shift in some allocations within fixed income and equities.
And so we've always watched, we've talked about on this show, an inverted yield curve. In other words, short-term yields are higher than longer-term yields. Why that happens, of course, again, is a disconnect from the Federal Reserve. All of this talk from James Bullard, the St. Louis president, may be what's called jawboning, and that's, in other words, telling the markets or trying to float a balloon to see how far they can go. Maybe this doesn't happen. Again, you've been listening to the show. I've told you, Derek, I don't think they're going to be that aggressive, and he may be jawboning while the chairman of the Federal Reserve, Jerome Powell, is more of a consensus builder.
And we've said for a long time on this show that this year we feel would be more about Main Street than Wall Street, meaning the Fed would probably be willing to see the stock market decline roughly 10% from its highs, because that would have a negative wealth effect. That would cause people to back off on consumption, which would relieve some of these inflationary pressures that are really starting to become a problem for the Biden administration.
And while they may be getting their wish, obviously with the Dow Jones down, the S&P 500 down, and of course the NASDAQ down nearly 3% on Friday, it is contracting, which in an ironic way is making the market cheaper as the earnings come in.